is Maloloran Anak Albert, and my matrix number is 20DSC25F1010.
My name is Hafiz Muzaffar bin Juma. My matrix number is 20DSC 25F1025.
3.
Hi and good morning. My name is Fair Maya Anaraman. My matrix number is 20DAC25F1031.
3.
My name is Kif Agiverski, and my matrix number is 20DSC35F1049.
3.
My name is Muhammad Musri bin Jamal. My matric number 20DAC 25F1061.
Hello and good morning. We are Group 5, and today we are very pleased to present our video on Topic 6, Accounting for Provision and Contingent Liabilities Asset according to MFRS 137. Before we begin, let us understand why MFRS 137 matters in the real world of accounting. In business, not all obligations are clear-cut. Sometimes a company may be owe money in the future, but the exact amount or the exact timing is uncertain. For example, a company may be involved in a lawsuit, or it may have sold product that might need to be repaired under warranty. How should this uncertain obligation be recorded? This is exactly what MFRS 137 Provision, Contingent Liability and Contingent Asset address. It provides clear guidance so that financial statement give a true and fair view of a company financial position, including obligations that have not yet been fully settled. Without this standard, company might hide liability, overstate profits, and mislead investor and creditor. MFRS 137 ensure transparency and consistency in financial reporting across all business in Malaysia. MFRS 137 applies to all provision, contingent liability, and contingent asset, except those that are covered by other standards. For example, financial instrument, insurance contract, and income taxes are excluded as they have their own specific standard. The standard was issued by Malaysia Accounting Standard Board, and it is equivalent to the international standard IAS 37. This means Malaysian companies follow the same global best practice when dealing with uncertain obligation. It is important to note that MFRS 137 draws a clear line between a provision which is recognized in the accounts and a contingent liability which is not recognized but may need to be disclosed. Understanding the distinction is one of the key objectives of our presentation today. By the end of this presentation, you will be able to achieve following learning outcome. The first one is explain the nature of provision and contingent liability and asset under MFRS 137, including the difference between legal and constructive obligation. The second one is describe the recognition and measurement criteria for provision, contingent liability, and contingent asset as required by MFRS 137. The third one is display and interpret presentation and disclosure requirement for provision and contingency as shown in the extract financial statement.
MFRS 137 defines three important items. First, a provision is a liability of uncertain timing or amount or both. It arises from a present obligation, legal or constructive, due to past events, where an outflow of economic benefit is expected. Unlike normal payables like salaries owed, provision involves uncertainty. For example, A smartphone company gives a 1-year warranty based on past data. Some phones will need repairs. This creates a provision for warranty costs. An oil palm plantation company must clean up environmental damage from past operation. Provision for decommissioning or restoration costs. A company announced restructuring, which is closing a factory and has already informed employees. Provision for redundancy payments. Next, a contingent liability. A possible obligation from past events performed only by uncertain future events outside the company's control, or a present obligation where outflow is not probable or the amount cannot be measured reliably. Contingent liabilities are not recognized as liabilities on the balance sheet, but are usually disclosed in the notes, unless the chance of outflow is remote. For example, a company is being sued for 800,000 ringgit due to a product defect. Lawyers says the chance of losing is only 30%. This is a contingent liability. Finally, a contingent asset is a possible asset from past events, performed only by uncertain future events. Contingent assets are almost never recognized to follow prudence. They are disclosed only if inflow is probable. If inflow is virtually certain, it becomes a normal asset and is recognized. For example, a company has filed a lawsuit claiming 500,000 ringgit compensation. If the lawyer says the chance of winning is 60% probable, this is going to be disclosed as contingent asset. If 95% virtually certain, it will be recognized as receivable. Now here is a simple comparison table on our sites. I will be explaining the items on this table. The first one is provision. It is recognized on balance sheet. It is also disclosed in notes, and the probability threshold is 50%. For contingent liability, it does not recognize on balance sheet, but it is disclosed in notes, and the probability is possible. For contingent asset, it is not recognized on balance sheet, but it is disclosed on notes. It is probable and virtually certain.
Now we move to recognition and measurement under MFRS 127. A provision is recognized only when all three criteria are met. The first one is a present obligation. Second is it is probable that an outflow of resources will be required. A third one is a reliable estimate of the amount can be met. If any criterion is not met, no provision is recognized. Measurement. The provision is measured at the best estimate of the expenditure need to settle the obligation at the reporting date. For a single obligation, use the most likely outcome. For a large population, use expected value. If the time value of money is material, discount to present value, use a pre-tax rate. Realistic example. The first one is warranty provision. ABC Electronics sells 10,000 phones with warranty. Historical data, 4% need minor repair for RM100 each. 1% need major repair for RM500 each. Expected value calculation, 400 times by RM100 plus 100 times by RM500 equal to RM90,000. Recognize provision of RM90,000. Second is legal claim. XYZ PhD is sued for RM1 million. Lawyer estimates 70% chance of losing and paying RM700 on average. Third one is onerous contract. A company has a list where unavoidable costs exceed benefit. Provision for unavoidable net loss. Contingent liabilities and assets do not meet the recognition criteria fully, so they are not recognized on the balance sheet. Only disclosed where appropriate. This approach prevents companies from creating cookie jars, provision to smooth profit, or hiding real obligation.
Finally, how should these items appear in the financial statement? Provisions are shown as liabilities in the statement of financial position, balance sheet, split into current and non-current where appropriate. Contingent liabilities and contingent assets are not shown on the face of the balance sheet. For each class of provision disclosed, carrying amount at the beginning and end of the period. Additional provision made amount use, amount reverse, and unwinding of discount. Brief description of the nature, expected timing of outflows, uncertainties, and any expected reimbursement. For contingent liabilities, they have nature of the contingent event and estimate of financial effect if practicable, uncertainties and possibility of any reimbursement. For contingent asset, they only have nature and estimate of the financial effect where practicable. Contingent liabilities. The company is involved in a legal dispute claiming 500,000 ringgit. Based on legal advice, the outflow is possible but not probable. No provision has been recognized. Contingent asset. A claim for insurance recovery of 200,000 ringgit is probable but not virtually certain. This disclosure helps users understand potential impact on the company's financial position.
To summarize, MFRS 137 promotes prudence by requiring proper recognition of provisions only when criteria are met, while contingent items are carefully disclosed. This ensures reliable and transparent financial statements. As a required, here is one question related to the topic. A manufacturing company in Malaysia is facing a lawsuit for Rm 1.2 million due to an airline breach of contract. Its lawyers advise that there is a 40% chance of losing the case. Should the company recognize a provision, disclose a contingent liability, or do nothing? Okay, so the answer is, since the probability of outflow is 40%, less than 50%, it is not probable. Therefore, the company should not recognize a provision. However, because it is possible, the company must disclose it as a contingent liability in the notes, including a description and estimated financial effect. Doing nothing would be incorrect as it fails to inform user of the potential obligation. Thank you for watching. We hope this video provides a clear understanding of MFRS 137. Thank you.